Remember 2020? The world shut down, markets face planted, and the Fed hit the big red button. Rates to zero. Then stocks flipped from panic to rocket mode. It felt like someone leaked Wall Street's cheat code. So here's the question: do rate cuts always send stocks to the moon? Or is the next cut a slippery slope with a fancy press release? Let's make this simple. Interest rates equal the price tag on money. When rates go up, the interest on your loans goes up too. Car payment, higher. Mortgage, higher. Credit cards, yep. Monthly bills rise means people borrow less, means spending slows, resulting the economy cools. When rates go down, the interest on your loans drops. Payments shrink, borrowing feels cheap, and suddenly, houses, cars, and projects get greenlit. More money sloshes around, which often nudges prices up. Last year, $2 bought 2 avocados. This year, the same $2 buys one. That's inflation saying hi. And stocks, they don't wait for proof. The moment investors think good news is coming, they jump. Wall Street is that friend who hears a rumor about free pizza and sprints to the cafeteria before anyone checks if it's real. Okay, so how did history play it out? 1987, Black Monday. Stocks crashed approximately 20% in a day. The Fed cut. It wasn't magic, but within 2 years, the S&P had recovered and hit new highs. 2000, dot-com bust. Rates were cut hard. The S&P still fell nearly 40%. Cutting doesn't fix a popped bubble. 2008 financial crisis, rates slashed to near zero. Markets kept falling, almost 50%, then finally bottomed in 2009. 2019, a trade war slowdown, 3 small cuts, no crash. The S&P soared approximately 29%. Same tool, calmer backdrop. 2020 COVID, emergency cuts plus stimulus. Markets plunged, then ripped, finishing the year up approximately 16%. Pattern? There isn't one. Sometimes cuts stabilize. Sometimes they fail. Sometimes they turn panic into liftoff. So why is go all in on a cut risky? Cuts can lift asset prices and your grocery bill. Cheaper money, pricier stuff. A cut is usually a stress signal, not a victory lap. It's like jumping into a taxi because the driver says, short route. Maybe it's fast. Maybe you hit traffic before the meter starts ticking. All right, what should you actually consider when rates drop? Bonds when yields fall. Existing bonds rise in price. That means bond ETFs usually go up. Real estate, lower mortgages boost affordability. Housing activity often improves. Gold and Bitcoin. A weaker dollar plus inflation fear can push them higher. Growth stocks, cheaper borrowing helps future earnings stories. Cash savers, your bank yield, probably headed south. Now the classic trader line. Buy the rumor, sell the news. Does it apply to rate cuts? For short-term trader, often yes. Markets front-run cuts. If you buy after the announcement, you might be late. If you are picking the long-term investor view, rumors matter less than earnings and time. Add gradually instead of going all in. Tilt toward rate-sensitive winners, but diversify. Let compounding work. When the Fed finally pulls the trigger, how would you invest? Launchpad or warning sign? Drop your thoughts in the comments.